Hello everyone, I'm Dr. Stock, and in this video, I'm going to keep it nice and simple. We're going to talk about the week that we just experienced, and we're going to talk about the week ahead. And as always, we're going to talk about what we expect in the markets, and then also tossing in there what we can expect from the Fed coming up, given what we have seen happen and what we think will happen. So while the markets may be uncertain, here's one certainty that we do have, that if you sign up using my link for Moo that you can find down in the description, when you deposit $100, you get 7 free stocks. 2 of those stocks are AI draws. The other 5 stocks are valued up to $2,000 a piece. Take advantage of it. If you have that $1,000 deposit to make, remember, that's still your money, but on top of that, you get 17 free stocks, still the 2 AI draws, and then 15 other free stocks valued up to $2,000. So take advantage of this. You can see the offer does expire at the end of March. Use my link down in the description to take advantage. Also, while you're looking down in the description, find the link for the Patreon, click it, sign up, get access to my Patreon exclusive videos, also get access to my private Discord and interact with me and my community members. You can get there through that link in the Patreon. With that said, I'm Dr. Stock, Doctor of Education. Let's get right into it. So in terms of the Fed, we have some good signs as far as their rate hiking goes, not necessarily good for people who are finding themselves unemployed. Initial jobless claims went up to 211,000, over 21,000 from what we had in the previous week, which remained unrevised at 190,000, and that is above the 4-week moving average of 197,000. At least in terms of that is something that takes a little bit of pressure off that 50 BP rate hike. Now, the bigger thing came along on Friday. Here we are. So on Friday, we got non-farm payroll, 311,000. That is about 40-ish% above consensus, which was over 200,000 that we were expecting. Well, we did get over 200,000. We went over 300,000 with this one. So not necessarily great because it did come in so strong. So that's what I say here. Not great for markets. Unemployment rate edged up for markets to 3.6%, up from 3.4%. So seeing a little bit more weakness there. And again, this is all relative to the Fed hiking. So that is something that did alleviate some of the pressures that we saw. We didn't have the same elevated numbers that we had where it was about 2.5 times what was expected for January when we came in at 517,000. That did get revised downward. I do have that later in here for you. And I did say over here that the unemployment rate moving up a little bit was good for markets. Again, related to what the Fed says. This is not about people losing their jobs, which it causes a lot of pain for people to be in those sort of situations. For me, being a teacher in Pennsylvania, seniority is one of those things that can keep my job around it if they do shrink the staff. And I can tell you, after 8 years at the same place, it still puts me at the bottom of the totem pole. So if the school decides to shrink down the number of positions that they have from this year to the next, then this guy's out of a job. And you know what? That's going to bring pain to my family. So when I say that unemployment rate going up is a good thing, it's relative to what I'm talking about. So relative to the federal funds rate, that is okay for markets. That, I think, adds a little, or takes a little pressure off of the markets. The downward pressure adds a little bit of upward pressure instead. Out of the 311,000 jobs, 105,000 of those jobs were in leisure and hospitality. And notice it's still below the pre-pandemic level of 410,000. So that means that there could still be a lot of hiring there, which could keep the numbers elevated. So that's something that we want to pay attention to. And then we also have something here for government employment, also below its pre-pandemic level. So we could continue to see a lot of strength coming through that. That was 46,000. So just between those two, leisure, hospitality, and government, what we have there is we're already accounting for about 50% of that increase that we saw, and that could be something that could possibly continue and keep those numbers elevated. So as we start moving further down through this report, we see that the cracks are starting to show. Information industry lost 25,000 jobs, and that's a decrease of 54,000 since November. That's almost 50% of those jobs just in February alone. So November, December, January, 3 months where half of the jobs lost. The other half of those jobs lost came in February alone. So that, in my opinion, is cracks starting to show. And then we have transportation, same story here, that just in February, 22,000 jobs lost. And this one since October. So it took 4 months to lose 20,000 jobs, and it took only 1 to lose the next 22. So I think that we have the cracks starting to show. Hopefully the Fed takes this into consideration, that they're not just looking at the headline numbers. And I don't think that they do that. I hope that they really start to read into it. And I do have other things that I want to mention. We also have signs of slowing wage growth, which again should take pressure off what the Fed does at their next meeting. definitely taking away from that 50 basis point hike, and I think we have bigger things to worry about than what we're looking at right here. I'll get to that, but we went down from 0.3 down to 0.2%, so wage growth is still growing, but slowing, and that could be good for what the Fed does at their next meeting. And then I have just a few other things that I wanted to remark on. Average work week for private non-farm payrolls, edge down, decreased. So when you look at those words, this could be because they're still adding jobs, so possibly that starts to lower the amount of work put in, but we are seeing those decreases in there per person. So that could be a sign of slowing demand as well, which could be a slowing economy, which could mean that whatever is happening with the Fed with the rate hiking, it could be working for us. Also, it's noteworthy that December and January both revised down. December 260 down to 239, so that's significant. That's almost 10% in a downward revision. January didn't have that same strong downward revision of 13,000. So it went from 517,000 down to 504,000. Honestly, I think a lot of this could be that families need income, that they need two wages working. There could be a lot that explains such a high number that we saw in January. The holidays are over. It's time to get back into it. We're going to need money to recover from this. And I think I've called for the Fed pause before, and I'm only seeing more data that supports my case that we really should just take a pause, chill out. The Fed said to themselves that it's going to take time, and yet when they do further rate hikes, that's exactly what they're not giving it, is time. So in my opinion, and I have pretty good evidence when you time it with the markets dropping the way that they did, this news comes out from the FDIC that they've taken over SVB, and so this bank is done, that they couldn't find investors to help cover the $2 billion losses that they realized by having to sell to cover the depositors. Doing a bank run, essentially, that they didn't have the cash on hand in order to give the depositors their money. And so the bank collapses. They used depositors' funds to take out bonds that held to maturity would actually pay off for them. However, they had to cash them out early, and they had to cash them out at a $1.8 billion loss. So then they had to cover that loss, and they couldn't find any investors to help cover them for that $2 billion. So that's when FDIC steps in, takes them over, and this news is what caused the markets to dump like they did yesterday during the trading hours. So are big banks well enough capitalized? Can they withstand the sort of shocks that something like this could create? A lot of economists, even including Cathie Wood herself, thinks that it's not going to affect the big banks the way it did back in 2008, and it's not going to affect them like SVB got hit this time, that they will not become insolvent like SVB. So let's take a quick look at timing now. So this is 10:46. So this is after the FDIC announcement. So this is reporting on the FDIC announcement. And like I said, we can look at the markets and see when that announcement hit. Even if the FDIC doesn't have it timestamped, the market pretty much has it timestamped for us. All right, so here we're looking at the Qs, and you can see in the pre-market hours that we were sort of trading sideways. 8:30 hit, and in the pre-market hours, the market responded positively to that we actually started moving upward. And then the market opened, we sold off a little bit, and then made a steady climb up until 11:36, which is where the market peaked. And then the FDIC had to go and take over SVB, that bank collapsing in on itself. And you can see the straight sell that we got from market. So it didn't even wait that 10 minutes until CNBC came out with the news, and I think their tweet came out at 11:46 as well. So some of that, maybe you see a little bit of a hesitation, and then when it really caught on, you see the rest of the sell-off take place. A lot of weakness in the NASDAQ when we look at that, and just because the NASDAQ, it doesn't really matter. This is actually the Qs, not the NASDAQ. But if we switch over to the SPY, which tracks the S&P, you can see a very, very similar story, very similar shape to what we had. 8:30. The jobs report comes out, pretty good for us. Market sells off a little bit and then decides that, this isn't so bad of a close. And I think especially as the Fed's funds rate got priced in, going from a 0.5 or 0.5% or 50 basis point hike being more likely the day prior to getting this report to immediately going that 25 basis points was more likely. That, I think, is what allowed the markets to start trailing upward the way that they did. SVB happened, and then it dropped back down. So let me wrap this thing up by talking about exactly two things. One, the Fed. Two, the week ahead. The Fed, 50 basis points, I think at this point is completely wiped off the table. I think them being that aggressive at this point, like if SVB doesn't give them pause, I don't know what does. Either stay the course at 25 basis points or just pause it. Like, just pause already. Let things stabilize. Let the ground get back underneath its feet. They know that there's lagging indicators. They don't know the impact of what they've already done, and yet they keep doing it. So take that pause. That's my opinion. My advice to the Fed. Now, for CPI, PPI, those inflation reports, those are going to be the next main influence that we get. If they come in cooler than expected, then I think that helps the case for that pause in March, that the Fed's like, there's some stuff going on that we don't understand. Inflation, January was a one-off. I think maybe perhaps we are moderating a little bit more than we expected. Let's pause. Let's wait here and see what happens. So in order for the Fed to be between 0 and 25 basis points for their rate hike, so either a pause or an actual small rate hike at their next meeting, March 21st and March 22nd, we're going to have to see the inflation reports come in my opinion, below consensus, that they're going to have to come in not only cooler than what we saw in January, but cooler than what we saw leading up to January. So we want to see a core CPI come in at like 0.3. We want to see PPI come in definitely well below that 0.7 for final demand. And we're just going to have to watch and see that happen. I'll have other videos coming out on those two things. So be on the lookout for those two things. So that's what I have for you for this video. If you want to hear more of my commentary, check out that link for the Patreon down in the description. Sign up, get access to my Patreon exclusives, and be a member of my Discord community that I have through the Patreon. We'd absolutely love to have you over there. Also, grab those free stocks from Moo by using my link down in the description. Sign up, deposit your money, get your free stocks. Remember, click that like button, hit the subscribe button if you haven't, ring that notification bell to see anytime that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.